love the channel and find it useful in becoming a happy retiree. Subscribe today. Good morning. Welcome to Money Matters. It's the last day of 2017 as we look forward to the new year. What a whirlwind year of Washington politics, GDP growth north of 3%. Stock market continues to marched all the way through the year except for the very last day. Time to shift our focus into 2018. Good morning. You know, it's New Year's Eve day, and there's a lot of football happening. I don't know how much people are really listening to WSB Radio Money Matters this morning. Hopefully, a ton of folks, because we have some of the best content of the year ready for you, ready to take you into 28. Such a good couple of weeks as we wrapped up the year talking about taxes. And we can still talk about taxes today. So we've got a lot of time the next 2 hours to take your calls and your questions. Of course, the topic of the last couple of weeks has been the passage of the GOP tax bill, the new Trump tax cuts, what they mean for your wallet specifically. I've been so wrapped up in tax cuts over the last 6 months, and particularly over the last year the last month as the Senate and the House started to reconcile. I was doing tax calculations for what the Senate bill would look like and what the House bill would look like and what it would mean for you. And then they combined the two bills, and the day it passed, I probably did 14 different interviews about what it's going to mean. And then I really started to understand it after I did a lot of those interviews. Fortunately, right before we did Sean Hannity was on vacation, so we filled in for a Sean Hannity show here on WSB in Georgia, taking your calls, kind of a Christmas special to try to help you figure out whether your taxes were going to be up, down, hopefully, for most people, or flat for a small percentage of the population. So we can continue to do that today here on Money Matters. So much to cover. I want to give you the outlook for 2018. I want to do a very quick recap of what we lived through in 2017 and what it looked like. We're going to look ahead because that's all that really matters to investors. We're looking ahead to 2018. And again, we'll continue to answer questions about your taxes and what that will potentially mean for you and give you some sort of estimation whether you think your taxes or whether we think your taxes will stay flat, go up for a small percentage of the population, or maybe go down significantly for some of you. So a lot in store today right here on Money Matters. Again, an awful lot happening in this past year. Kind of fascinating market statistics. The year that we just lived through. Let's maybe call this the year, the unsung year of hyperbole. Really massive gains in the market, not just in the United States, but in other markets around the world, but to some extent cloaked by one of the most placid years we have seen since the 1960s. You've heard the president, you've heard Trump talk about or tout how good the market was doing throughout the year. And you've heard Trump 70 plus record closes in 2017. And as we speak today, 71 for the Dow, to be exact. 71 record closes. None really all that dramatic, though. Just this small stair-step by stair-step by stair-step climb that resulted in a 20 to 25% higher stock market here in the U.S., depending on which index you looked at, or what index you looked at. And then if you looked at the ACWI, the All-Country World Index, up around 25% as well. For the month of December, the Dow up about 1.8%. That's the 9th straight month of gains for the Dow. That's the longest winning streak for the Dow since it was up 12 months in a row, all the way back in the latter, or in the beginning of 1959. So 58 ending in 1959. The S&P was also up for 9 straight months, and that matches a streak that ended in April of 1983. And if you look at it from a total return perspective, and meaning counting dividends, and dividends matter, and there's a little bit of a difference. Remember, in any given year, you've got to add on the dividend amount. Very often we were quoted. If you look at Barron's or Wall Street Journal, they typically, the chart you'll see is the price change of the index for that year. So if you go to Barron's and look at it from this weekend, it'll say for this year, the S&P 500 was up 19.42%. But then you have to add dividends onto that, and that takes the return slightly above 20% for the year. So if you look at a total return basis, counting dividends, the S&P 500 was actually net positive every month in 2017. NASDAQ up for the 6th consecutive year. That ties its longest winning streak on record. That happened only 2 times in history, 1975, 1980. So I want to take a quick look at what market history tells us about what happens when you follow up a really big year. So I would say this year is a very good year. 20% gain. Nobody's going to argue that that's not a massively good year for markets. Since 1943, we're going to go do a quick history here. If you go back to 1943, the S&P 500 returned how many times? 20% or more. How many years did we get a full 20% lift, including dividends? So we're looking at total return basis. Well, that happened 26 separate times. 26 separate times. 20 times following the year where we had this big, massive positive, we had an uptick. So the majority of those years, if we want to actually do the math on that, 20 divided by 26, so we can say that 77% of the time following a 20% up year, it was followed by an up year. And by the way, the average of those up years, 12% the following year. A few other stats for the year that we wrap up 2017. If you nailed the very, very bottom, so let's nail the bottom of the market on March 9th, 2009. You would have seen how much can you think, just for a second, how much is the market up since that very bottom? The answer, 376%. What? I'll say that one more time. The answer, 376% or 19% per year average. Now, just remember, before you get too excited about that rate of return, that's just nailing the very bottom of the day. You're not going to see that as a annual rate of return for 2009 because we had a huge waterfall decline in the beginning of 2009. So a lot of the 2009, when after the market bottom, just was getting back to where we were, and then the market plowed into positive ground. So just remember that when you hear these market statistics, and I'm guilty of this too, I'm citing extremes very often. So if you nailed the very minute of the very bottom of the very worst day of 2009, March 9th, and then you bought the S&P 500 on that day and never sold a penny, you would find yourself up on average 19% per year. Now, diversified portfolio, of course, it's going to look a lot different than that. Remember, if you owned Apple, it would look a lot different than that. So this is just if you're looking at the general market, that's what things have done, or that's what markets have done since that very, very dark and scary market day in the beginning of March. Also, since markets started out on a positive note, this is another kind of interesting note about 2017, and it experienced very little volatility on the downside. There wasn't one day in 2017 where the S&P 500 dipped below its 2016 year-end mark. This is probably the most shocking or rare piece of what we saw in this past year, 2017, over the last half century. A normal day, very normal day to get a 1% move in the S&P 500. Up 1%, down 1%. You go back into the volatile days of 07, 8, 9, we'd see 2%, 3% in a given day. On average, you blend all the placid years and all the volatile years, the S&P 500 over the last 50 years has moved on average about 0.75% on the average day. So almost 0.75% on a normal trading day, every single day of the year on average. In 2017, volatility was less than half that. The lowest since the 1960s, closing out one of the most, let's call it one of the most unsung, placid years on record. An unsung year of hyperbole. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.